Hi, my name is Vera, and I will be doing a presentation on financial analysis report on Chipotle and Yum. So this is just the table of contents. I will be going through these sections in a bit. So for my executive summary, from an investor's perspective, it is better to invest in Chipotle Mexican Grill Inc. than Yum Brands Inc. because their financial statistics based on income statements, balance sheet, and cash flow statements have improved over the span of 3 to 4 years and are steadily growing compared to Yum. In this report, the four following sections will be stated and explained to support the argument: liquidity ratios, borrowing capacity ratios, profitability ratios, and cash flow ratios. So for liquidity ratios, I will be covering working capital, current ratio, and quick ratio. So Chipotle has had an increase in working capital despite the drop down in 2022, ranging from 507K to almost 600K if the outlier is taken out. You can see the trend from this graph. And on the other hand, Yum has had a negative working capital in 2022, and the number for the other years aren't quite high either. So that means it doesn't have enough assets to cover the liabilities. And both companies' financials has taken a significant drop in 2022 due to the global stock market decline. It will be demonstrated later in the analysis of other financial ratios as well. So therefore, Chipotle has had a higher working capital than Yum. And then for current ratio, it is calculated by dividing current assets by current liabilities, and a number between 1.5 and 3 is considered a well-performed number. So Chipotle's current ratio has been stable for the past 4 years, ranging from 1.27 to 1.58. And Yum has had a ratio ranging from 0.97 to 1.25, and it means that their current assets are only 1.25 times at most of current liabilities to pay off their short-term debts. The reason why this happens is probably because that their current assets stay the same from 2022 to 2023. It is possible that the restaurants have received a closed amount of cash and net receivables for 2 consecutive years. And in summary, Chipotle has had a higher minimum current ratio than Yum, and it proves that Chipotle has made more effective cost management issues and developed a better level of operational efficiency. And lastly, quick ratio. It is calculating by dividing the current assets above inventory by current liabilities. A number of 1 or slightly above is considered ideal. Chipotle's quick ratio has been floating around 1.09 to 1.36, indicating that it has enough liquid assets and a strong liquidity position. So you can see that from the trend here, it does not move much. For Yum's quick ratio has been floating around 0.61 to 0.98, which is less ideal than Chipotle because it has never exceeded the ideal number of 1. This proves that Yum relies on inventory sales more than Chipotle since it has less liquid assets to pay off short-term liabilities, and etc. And in conclusion, Chipotle has been performing better than Yum in terms of liquidity ratios since it has a higher working capital, current ratio, and quick ratio than Yum. And moreover, borrowing capacity ratios is important, and I will be covering debt ratios and equity ratios in this report. So for debt ratios, it is calculated by dividing total liabilities by total equity, and a percentage of lower than 50% would be ideal. So Chipotle's debt ratio shows a slight decrease over the past 4 years, and it ranges from 61 to 66%, which still has room for improvement, but it's not a bad ratio. The main reason this happens is because its total assets have been steadily increasing over the years. And on the contrary, Yum has experienced debt ratios in the range of 226 to 252% due to total liabilities always being more than 2 times more than total assets. So its total liabilities and total assets haven't changed drastically for the past 4 years, resulting in the debt ratio staying in the same few percent. And then what's more, equity ratio. So you calculate it by dividing total equity by total assets, and a percentage of more than 50% is appropriate. So for Chipotle, its equity ratio ranges from 33 to 38% and has shown a stable increase by 1 to 2% each year since 2020. And although it is relatively far from an ideal equity ratio, it is better than Yum since it has been negative for the past 4 years. So Yum has a negative equity. It can be due to possible factors such as asset write-downs, poor capital structure management, and legal issues. For example, in 2023, Yum Brands faced a class action litigation in U.S. federal and state courts in connection with the January ransomware attack. The lawsuit asserted that the company failed to secure employees' personal identifiable information, resulting in a data breach in January 2023. So as you can see, the equity ratio has been negative for the past 4 years. And in addition to liquidity and borrowing capacity ratios, profitability ratios are also vital to a company because they measure the ability to generate profits relative to its revenue, assets, equity, or other financial measures. So in this report, I will be talking about return on net sales and return on equity. So return on net sales, also known as profit margin, is calculated by dividing net income by net sales revenue. And the industry average for a restaurant is around 7% in the US, and Chipotle's return on net sales has increased by 2 to 3% per year since 2020 and ranges from 6% to 12%, which is 5% more than the industry average. This happens because Chipotle's net income has increased by around $300K yearly since 2020, and the number is still growing. See how it is a straight line up. And Yum's overall return on net sales has a higher range from 16% to 24%. Normally, I would say it's better than Chipotle, but however, it demonstrated an unstable trend from 2020 to 2023 because it had an increase in 2021 and a drastic drop in 2022 here, as you can see. So this is due to the 250K increase in operating expenses in 2022, ultimately decreasing the net income. And then another ratio in the profitability ratio category is return on equity. So return on equity is calculating by dividing net income by average shareholders' equity, and a number between 15 to 20% is usually considered good. So for Chipotle, it ranges from 8 to 11%, showing slow but steady growth. This is because its shareholders' equity has increased around 200K per year since 2020, and it proves that the company is investment worthy. So look at this graph. The return on equity and return on assets are both growing over years. On the other hand, Yum has been experiencing negative return on equity ratios because its shareholders have always been very, very negative every year. However, Yum Brands is a restaurant franchise that owns Burger King, Wendy's, Taco Bell, etc. It does not need a large amount of physical assets to generate revenue, and the revenue comes from things that they don't own. So nevertheless, it would be more ideal to have a positive return on equity for Yum to be more successful in terms of managing fast food chain restaurants. And lastly, cash flow ratio is a financial metric that measures a company's ability to cover its debt obligations using its operating cash flow. In this report, I will be covering cash flow to total debt ratio and cash flow per share to compare the two companies in terms of which one is a better investment. So cash flow to total debt ratio is calculated by dividing cash from operations from average total liabilities. And the higher the better. So Chipotle's cash flow to total debt ratio has shown a steady increase over the few years, growing from 7 to 9%, and this is because cash from operations has escalated for 600K sharp yearly, making a remarkable growth in cash. I would say it is increasing rapidly. And Yum's cash flow to total debt has shown a tiny decrease over the past 4 years, dropping from 3.4 to 2.7%. This could potentially be due to Yum's net cash from operations being inconsistent. It was increased by 400K in 2022 and dropped in 2023 by 279K. And then cash flow per share, it measures the amount of cash generated by a company per outstanding share of its common stock. So you take the total cash flow from operations and divide it by the number of outstanding common shares. The higher the better. And Chipotle's cash flow per share has grown by $0.01 per year since 2020, increasing from 0.011 to 0.044. And this is because its cash from operations increases by 300K each year as well, resulting in a higher cash flow per share. It is growing. And then Yum's cash flow per share has remained roughly the same since 2020, ranging from 0.0038 to 0.0047. This happens because its outstanding common shares have decreased from 3.07 billion to 2.9 billion, while the cash from operations was up and down a lot. Thus, the change in both balance each other out and the cash flow per share stay the same. As you can see, it takes a drop and then it comes back, but overall, the number is 10 times smaller than Chipotle's cash flow per share. And that is everything. Thank you for listening.